And just like that, we're up and running. The first business day in March. Greg Sher here. One-on-One is up and on its way live. I'm in Northern Virginia. My guest, Justin Wiseman, who's the VP of and Managing Regulatory Counsel at the Mortgage Bankers Association, is with me from not too far away. Parts unknown, but not too far away.
Bethesda, man, right across the river.
Listen, you're a guy everybody wants to get a hold of, so I didn't want to give away any more information than you were comfortable giving. So good to see you.
Good to see you. Thanks for having me on. Really appreciate it.
Yeah, man, we got a lot to cover here. Of course, the Mortgage Bankers Association does fine work for a lot of IMBs and other folks in the industry. And boy, we have a lot of things to cover today. I mean, I know the top 3 things that you guys are working on right now: finishing Reg Z servicing reform rules, RESPA Section 8, potentially looking at that 50-year-old rule, and then LO compensation, which is something that is going to be really interesting to everyone listening to this call for sure. So we have a lot of ground to cover, but real quickly, why don't you give us a pulse of what's happening with inside the walls of the MBA, given all the swift and steady movements coming out of the new administration? It's pretty hard to tell heads from tails, I would imagine.
Yeah, no, it's been an exciting transition period, to put it mildly, right? We almost liken this to being on the footing we were at the beginning of the pandemic, where we had to kind of expect new developments and rapidly respond to them as they came up. And our great strength in doing that is our members, right? We have the relationships in DC, and we talk to the folks that we need to talk to when issues arise. But the thing that's most important is we don't see everything. And our members, folks like you, Greg, and the people listening to this, if there is something that kind of breaks down or that there's a concern they have, that they raise it to us so we can take it forward. And just one example would be the CFPB's publication of the average prime offer rate, or APOR. Obviously, there's plans to dramatically reshape the CFPB, but we reached out to make sure that the APOR publication would continue, because as folks know, that's an important number, very important number for the QM calculation.
So Bob Brooksmith, president of the Mortgage Bankers Association, I think it was at Housing Wire. I know it was at Housing Wire in Dallas, the IMB summit. He spoke and, of course, was asked about the upcoming election, right? We didn't know then what we know now, but one of the things he said was, almost just a paraphrase, and of course, I recorded it. He said, to the extent of, be careful what you wish for. Like, we know the administration we have. And the fact of the matter is, and I share this view, enforcement was nothing crazy. Like, the CFPB was doing their thing, and for the most part, Chopra and the agency left IMBs alone. Now, obviously, there's some outliers. There were several things brought to a couple of the bigger players, Freedom and Rocket. Now, one of the Rocket suits has been dropped. I mean, there's a lot to cover here, right? But one of the things Bob said was, be careful what you wish for. That at least we know with the Biden administration what you got. With the Republican administration, who knows? So in that context, what do you think so far about what you've seen with the CFPB being unwound, muted, whatever adjective you want to use, and how might that impact the mortgage industry?
So I think one thing that I try and keep in mind during the transition period is although it feels like this has been a lot longer than it is, we're really only 6 weeks into this. So I think it's probably too early to fully know what the CFPB is going to look like in 6 months, a year from now, or, at the end of the Trump term. I am very heartened by the nomination of Jonathan McKernan. He has a ton of experience in the housing finance area. And in fact, the CFPB obviously is a pretty young agency. But if you look at the past 4 directors who've been the permanent directors, I would argue that Jonathan McKernan has more housing finance experience than any of those previous directors. He was at FHFA. He worked at GSE reform in the Senate, and he was on the FDIC. So he sort of understood our issues from that lens. And that, to me, is a very positive sign that we could see a CFPB that's open to hearing our arguments and making more changes that would benefit industry and consumers alike. Now, you bring up an interesting point as well. As the mortgage industry, we've been tied to the CFPB by Dodd-Frank in ways that other industries might not. So, and we can dive into this deeper. I do believe that we need a functional and responsive CFPB, but it doesn't need to be the exact same size as it is now.
No, clearly it's not going to be. The caveat is they can't shut it down without congressional approval, right? So,
Correct. Yeah.
yeah, so it's probably not happening, but the fact that he nominated somebody that may be friendly to housing, I mean, Pulte's another name.
Yep.
That obviously, the Pulte name is synonymous with home building, and they've done some great things, and he's done a lot of philanthropic work. So it'll be interesting to see how things shape up there. Let's jump into LO Comp.
Sure.
Now, I think real quickly, before we jump into the specific things like RESPA Reform, LO Comp, and other things, just real quickly, in your role at the NBA, how closely do you touch those items, and what are the things that you're most focused on? Then we'll jump into the specifics.
Yeah, no, absolutely. So I have the privilege to lead our residential policy team. So I and my team work on kind of all of the issues that the federal government agencies touch on. I've got great colleagues who work on the secondary capital markets issues, work on the legal and regulatory compliance issues, which is probably where I spend a little more of my focus relative to the other issues, but also government housing finance. If you've heard of a NBA policy committee, which are so important, and if you haven't heard of them, I encourage you to, if you're an NBA member, to look them up. But those committees are all run through my team, and that's how we build our policy that faces the federal agencies, including the CFPB.
All right. So you are a guy that knows what he's doing. So that's I already knew that. But I think it's important. I think it's important in the context of the audience are hearing Justin Wiseman, and I want to just substantiate that you are in the room for these conversations. So the LO Comp statute in Dodd-Frank, we want that looked at. A lot of members want that looked at, and I know you agree that it needs to be looked at. To what extent do you feel like you could make some progress on it, and how might that manifest itself?
So there's two avenues to change the LO Comp world in which we live, right? The first is the one you mentioned, which is the statute. That's part of the law, and even if the CFPB is greatly diminished or goes away, which both of us don't think is going to happen, that law, the LO Comp law and its restrictions, would still be on the books. And changing that law would, barring changes to the filibuster, require at least 60 votes in the Senate, which I think is highly unlikely. So our viewpoint has been and will continue to be that the best way to change the loan originator compensation rule is to do it by changing the implementing regulations that the CFPB has put out. And those largely form the basis of the rules under which the industry is governed. NBA, back to the Kraninger tenure at the Bureau, has had three main sort of priorities around loan originator compensation. The first is allowing for lower comp on bond loans. The second is allowing for clawbacks when there are loan originator errors, consistent with state wage and hour law, right? It has to be consistent with the law. And then the last and perhaps most controversial is allowing for competitive concessions. That is allowing a loan officer, when there's demonstrable competition, to participate in the pricing concession by giving back some of their comp to lower the price. All three of those issues have been socialized with the Bureau during the Kraninger tenure. We have written letters to Director Chopra about these issues, and we plan to take it up with Director McKernan if and when he's confirmed, although I think most folks expect he will be.
I saw former Director Chopra on CNBC this morning.
Oh, wow. All right. I saw him on the street on 19th Street. It was weird. He's walking down the street.
Yeah, I'm wondering. Yeah, that's odd. I'm wondering if he shows up in the private sector or somehow remains in some capacity government-wise. Any feeling on what he might do?
So I don't really have a personal relationship with him. Folks aside, people might disagree with his tenure at the Bureau. I think he's a pretty sharp and well-read-in guy. So I'd be surprised if he didn't land somewhere with a significant platform.
How do you think he did when it came to the mortgage industry? How would you summarize the 4 years under the Biden administration? Was he a friend to the IMBs? Was he a foe? Somewhere in between?
Wow. So are you asking me how I think he did overall, or how I think he did?
If you're, put yourself in the shoes of an IMB, right? And, if you were an IMB, you obviously deal with a lot of IMBs, and you're on the other side of the table too. So as IMBs, we look at his tenure. For me personally, I think, hey, could have been a lot worse, ruled too much by enforcement, but I give him a fairly high marks. I love what he did with credit, going after the injustices there and the price hikes. So I'm just wondering from you, from your perspective, how you feel like he did.
So I think from the mortgage industry's perspective, it was a pretty quiet tenure, right? There weren't any significant rulemakings. There were not a ton of enforcement actions. It wasn't like we were the focus of his administration, the way that like banking and overdraft fees and other things like that were kind of more of his focus. So in that respect, I think, yeah, it was a relatively benign tenure. My critique, if there would be one, of Director Chopra, and this is maybe just the fact of life now that the Bureau is an independent agency, but he dramatically politicized in some ways the Bureau. And what we're seeing now is in some respects a snapback or a backlash to the politicization and the use of the bully pulpit and some of the tools he used that people feel are beyond his statutory tools and beyond his given ways by Congress of kind of influencing behavior. We could call them sub-regulatory or like outside the regulatory sphere tools. And is an agency that is important to us where we need stability, I think a rapid swing back and forth between two pendulums is just going to be problematic. And I think Director Chopra arguably contributed to that.
Oh, it's scary when you have one person wielding so much power.
Absolutely.
With an industry in their hands. That's why I like the idea that Bob Broeksmit brought up. I think this was at the annual in Denver, and that was this idea that David Stevens, I think, started of a housing czar. One person that could represent the industry. I don't want to go into too many directions that are off the beaten path for you, but just a side note to that. This is right in your wheelhouse. Let's get moving here. So,
Sure.
So this idea of CFPB being muted and lots of the regulators, lots of the examiners rather, going to states and us seeing a bolstered presence and more enforcement on the state level. I want your feedback on that. Director Chopra did release sort of his own roadmap. I think it was January 14th on his way out the door. He drafted this letter to the states saying, this is how you enforce all these laws. I don't know. That was kind of weird. But do you think that's going to be a thing? Do you think that states are going to really step up what they're doing? And to the point of a post I did this weekend, I mean, there is a danger there, right? Because the states do need revenue that mortgage companies drive in to help fund their operations.
Yeah, I think the risk of more state enforcement, particularly in blue states where they might perceive a vacuum, is definitely going to be higher. I think that probably is the case no matter what. It's a little bit of kind of political partisanship. When there's a Republican CFPB, blue states are probably going to be more active no matter what. But if the CFPB is significantly diminished, or the perception is that they are off the beat, I would expect that to increase even more. And so, yeah, I think there is a risk to IMBs of more state oversight and also more state examinations of that if they perceive a vacuum. The thing I would note is that the states have always had the ability. I mean, Director Chopra circulated that that writing to the states, but the Dodd-Frank Act explicitly gives states attorneys general the authority to enforce parts of the Consumer Financial Protection Act. So they've had that pretty strong arrow in their quiver since Dodd-Frank was passed.
I mean, is there precedence for this? Not to put you on the spot, but can you think back to a point in time where states were really, had a loaded gun and were firing, like at a rapid clip?
So, I mean, I think probably the most signal example of this would be following the financial crisis, the national mortgage settlement, which sort of was with, I think it was the top 12 servicers. And it was off the top of my head, I want to say like around 25 billion in relief. That really was spearheaded by state attorneys general. Now, granted, it was a wildly different context than the one we're in now, but it does show the power of state attorneys general working in concert to try and achieve an objective. So yeah, that would be one example that definitely comes to mind.
So what I think about is all the warnings. I've heard from many people in the industry, including a little bit from the NBA, like be careful what you wish for. Muted CFPB could mean more enforcement on the state side. It's like, I mean, are we ever going to be out of the line of fire? It's like, it just seems like we just move one problem to another place. And what I'm hearing you say is it's pretty real. Is there any limitation if you're an IMB that's licensed in 30 or more states? Is there any limitation to the amount of examinations that could be going on at one time? Let's just say that the states just start a frenzy and they're just going crazy, and all of a sudden you're getting 10 exams in the next 90 days. Do you just have to comply with that, or are they forced to reason with you?
So I think each state pretty jealously guards their own sovereignty, right? They would not say like because New York is doing an exam, Wisconsin can't do one. But you can always ask your examiner to reschedule it if you're truly overburdened. But also, and I think this is important, CSBS and its multi-state mortgage committee, I believe, are continuing to work on efforts for one state, one exam or multiple exams, one exam by multiple states. And that's a really important initiative. And I think that's something CSBS should continue to push forward, right? The basic idea being that if the examination report produced by one state is sufficient for, say, 10 states, that would relieve the examination burden on the examined entity. And they would only be responsible for any additional information to those states, but not a full-on exam.
Okay. So thank you for that. I read over the weekend that there's this idea of AGs teaming up with other AGs, like communicating with AGs in various states and collaborating and a team effort. I've never heard of that before. Is that a real thing? Like, and how would that present itself if so?
Yeah, so that functionally was what happened back in the national mortgage settlement, right? That they were working very closely together to drive basically a nationwide settlement through their powers as state attorneys general. And they would communicate probably most likely through their affinity group. So there's something called RAGA, the Republican Association of Attorney Generals, and DAGA, the Democratic Association of Attorney Generals. And if there was to be that kind of coordination, you would expect those bodies or ad hoc arrangements would be where they talk. I don't know that there are problems that are so widespread that it would drive that level of their attention and coordination. I think the thing we should keep in mind, maybe the countervailing force to the state examination fears, is that attorneys generals in the states have a very broad waterfront to cover, are usually not extremely well resourced, and kind of have to pick their battles, right? So they are definitely going to be attracted to consumer financial protection if they perceive a vacuum. But many states are also going to be trying to do things on immigration, employment law, other areas of focus, and where they may choose to deploy their limited resources.
Very interesting, my friend. I'm a little distracted by the doors behind you. I know you're blurred out there, but
Yeah.
you have an unusual amount of doors in one small space. I think I see 3 doors behind you. I'm going to guess we've got a bathroom, a hallway, and a closet. Is that right, or is there something else going on?
No, man, you're right. It's a lot of doors because I've got 4 kids, so everyone's got a bedroom. There's only so many places I can work out of at the house.
Well, and you have to be able to run, because you're in a wild business, and
yeah, no, that's the window. You
I
can't
get
see
it.
that. That's what the window.
If all that's true, I should probably have 100 doors around me because Lord knows who's chasing me at any one time. We're at halftime here. How's this going so far?
It's great, man. I appreciate the conversation.
We're like midway through the third quarter. I'm not that scary.
No, I come on, man. You're not scary at all. I appreciate it.
That's what I keep telling everybody. I'm not, I'm a fair guy. Yeah. And you do spend a lot of time on LinkedIn. I know this.
I appreciate LinkedIn as a platform for communication, and it's really taken off in that respect in the past couple of years, right? I think you get more information on LinkedIn now than you did, 3-5 years ago when it was kind of a more anodyne platform.
A lot of armchair quarterbacks on there, huh?
A lot of armchair quarterbacks on all social media, man. You can't go to any site and not find the armchair quarterbacks.
Well, I know you don't mind. You just want people to get their facts straight. And that's one of the reasons why you're on here, because, I did, potentially take some things out of context, according to you. So let's dive into RESPA reform, because I've got some things printed here. I've got some highlighters. I've come prepared here, buddy. So
I appreciate it, man. Everyone read the paper. Read it like Greg did. And if you got questions, let's hash them out.
Well, I read it, but I'm not going to tell you I understood it fully. So, okay. I'm trying to make sense of it. It's in legalese and it's in a language. It's almost like a foreign language. I think it's 40 something pages. And so look, you said I took this paragraph out of context. So, this is the executive summary. This is page 1. And I'm just going to read the first paragraph here and ask you to help us make sense of this.
Sure.
In any other industry, it would generally be acceptable to make a payment or give a gift out of appreciation to someone who puts a buyer in touch with the seller. This is not the case in residential mortgage, where such standard business practices can lead to fines and even possibly jail time. So, look, to the lay, I read that and I say, all right, well, this is saying that you should be able to, Justin, you give me a lead. You give me your next door neighbor. Hey, John's looking to buy a home. Hey, thanks so much, Justin. Here's a 200,000. Sorry, you wish 200,000. A $200 gift certificate to Ruth's Chris, your favorite restaurant. Thank you so much. Personally, I don't see a problem with that. I do understand that that's normal. I'm in most other businesses, you don't get policed like we do, and we're still paying the price for the financial crisis. That's a whole nother conversation. But am I reading this right? That you are framing this in a way to say that this should be looked at, and that it's possible that people like these other businesses that you referenced should be able to give a gift of appreciation to someone that gives you something that rings your register?
So first thing is paper's been written not just for mortgage industry professionals, but for lay readers. And just to your earlier point, I mean, we have executive summaries, FAQs, and other things to hopefully demystify it. But the point of including that at the beginning is simply a descriptor. If you, for example, are a staff member on Capitol Hill and you're reading the executive summary, you don't know the first thing about RESPA. And it might strike you as a little strange, just the framing that what's customary. Hey, man, thanks for referring your brother-in-law to my business. Here's some CAPS tickets. In any other line of work is illegal in the mortgage context. So we're trying to help people understand in some ways how RESPA is an outlier. But to be very clear, nowhere in the paper and nowhere has MBA ever advocated for allowing for the explicit payment for referrals. That's not what we recommend. And absent a repeal of RESPA Section 8, I think that's very unlikely. And it's a different conversation as to whether or not people should think about repealing RESPA Section 8, but that's not one of the recommendations made in the paper.
All right, page 24, moving right along. Marketing services agreements and desk rentals. The methods by which the CFPB determines whether an MSA is an illegal hidden referral fee remain murky. Some marketing space is inherently more valuable than other spaces for certain uses. So the paper goes into fair market value and what seems to be a fact, right? Like if you are in a space that has a tiny little small owned brokerage with 3 real estate agents, it's probably not as valuable as being in a Keller Williams with 400 agents and a title company upstairs and homeowners insurance across the way. So what is this idea of fair market? And if this comes to fruition, how would that be attained? Would that just be something that the entity on the mortgage side describes? Like, here's why I think it's worth 5 times what the one at our old place is worth because of all these things in here?
So, yeah, I think part of the desire to move to fair market value is the same desire that underlines a lot of the paper. It's lowering the compliance burden for all lenders. And in this case, it means not having to go out and get a general market value survey from a third party. In theory, a fair market value is an arm's length transaction. It's open, to other people to bid on, and you simply give the space to the person who's willing to pay the most for it. Now, the important point to underline here is that does not still allow for hidden referrals or backdoor arrangements, right? It would need to be a fair market value lease. To use simple numbers, I'll pay you $1,000 a month for this desk, and not I'll pay you $800 a month for this desk. And if I get 200 referrals, I'll pay you an extra $400. None of that is embedded in the fair market value concept. The fair market value concept simply says that the space's value is worth what someone in a free market is willing to pay for it, and an arm's length transaction should allow for people to find that true fair market value without complex valuations or being subject to question that they somehow misread the general market value standard.
Right. So, I mean, that takes me to what I view as a concern as I'm at a larger IMB, right? So this really doesn't speak for me. It speaks for all of us. More of the folks that are more the mainstream, smaller-ish. To some degree, I think you and I talked as we were teeing up this conversation. It's capitalism, right? Those with the most money tend to win, and it just is what it is. In any other business, that rings true. In the mortgage business, we've had our teeth kicked in a bit, and everybody, for the most part, is pretty overprotective. So, in that scenario, the smaller IMBs might be on the outside looking in, and here's why: because they don't have the deep pockets to be able to match Rocket or a Freedom. And I apologize for, I'm not attacking them. I have immense respect for both institutions. I really do. But what do you say to the smaller IMB that looks at this framework and says, gosh, man, if I've got to go up against them and all of a sudden they're able to just put a fair market value on something for one reason or another, I can only afford to do so many of those until I'm on the outside looking in. Is that just is what it is? What is that?
I mean, so the first thing I would say is I would argue that any large player is also better positioned to do more complex general market value analysis. So I'm not sure the current framework, the change would be so dramatic there. But to that person, I kind
What
of
does that mean? Go before you go farther. I'm thinking maybe because they've got a more streamlined process, they have more they're able to move things along or do more with less. Am I
well, then
going
they
on the
also
wrong?
they hire the consultants that you need to determine the general market value. They have more resources to throw at RESPA, MSA, and desk rental compliance, right? So if this was a huge and winning strategy, they would probably be pursuing it more now than they appear to. That's kind of where I was going with that. I think the larger point, though, and we touched on this in our pre-discussion, is if you're a small to mid-sized IMB, your point is, capitalism, you throw the most money at the problem. Well, I don't think you win the game by throwing money at marketing. You'll never be able to outmarket in terms of spend the larger competitors, be they IMBs or banks.
Well, you say that, but there is a use case that comes to mind, and I apologize for cutting you off. UWM, I mean, they bought the market. They decided to take it in the shorts, lose more money than anyone else just so they could pick up market share. So there are scenarios where you could have a large institution just box everybody out to pick up market share. And to some degree, yeah, that happens. That's a strategy. So I don't think it's as clear. It's as easy as to say, well, if that could work, they'd be doing it already, because we know that Rocket and Freedom have run into a bit of trouble, justified or not. They have had the government looking at them for some of their practices.
Yeah, I think neither of those practices implicate desk rentals, and I think the
no, but RESPA violations, that's come up.
Yeah, well, I don't
want you to get into the weeds on that. I don't mean to put you in a position. I'm not trying to do that to you. And so my point is, please, MBA. You always talk about, when I have a conversation with you, you want to hear from.
I know. I do want to hear from you. But
so my message to you guys is get the feedback from everybody, smalls and bigs. And if you do that and you look at the potential pitfalls, then I think everyone will feel good about that. I'm scared of a scenario where RESPA is loosened considerably enough that those big players that are publicly traded are going to be able to get as big as they want, maybe make a sacrifice like Ishbia did, and then we could look up in a world, and this is very Oliver Stone-esque, so I don't think this is going here, but we could end up in a world where there are three players, and what happens to the NBA in that scenario? You guys would collapse. You need all of us. So that's my only.
Absolutely, we're better.
That's my only point. That's my only point. It's not an attack.
No, I get it, and we're better for being stronger by having a large, diverse member base and representing their interests. The question I'd ask you, though, and we kind of didn't get to this, is would you agree or disagree that the core value proposition of a small to medium-sized IMB is their expertise? It's their reputation in the community. It's the value they bring to borrowers. It's their long track record of delivering value in their particular community.
No question. I'll just answer you right now. You don't need to go on. Yes, right. A huge value.
Right. So it's not that they can buy, more advertising digitally. It's not that they can afford bigger billboards than their larger competitors. It's they've done the shoe leather work to build that reputation.
Well, I go back to the two, and I'll just go back again. I'm so sorry, but
no, go for it.
Rocket tried to go push button, get mortgage. They tried to digitize the whole experience, and they thought that it could work with a call center. And, I'm sure that they're adjusting now. Freedom, for the most part, has been doing a lot of servicing. So that could change fast, though, Justin. So if those two entities,
you were just, I think, making my point that the small entities are a little more resilient. A little more resilient than you give them credit for.
Nope, that could change fast. I mean, I hear that Freedom is ramping up right now a strategy to get more purchase business up and running, and who's to say they can't go acquire a national lender that has boots on the ground everywhere? I think that's going to happen. I really do. Like in the next 12 to 24 months, both those entities are going to do something, and they should. by the way. They should. So, if that were to happen and all of a sudden they're in the communities, which has been the mistake, right? That's the one last thing that we're holding on to is smaller IMBs.
It's a pretty important thing there, though.
Yeah,
It's pretty
we're
important.
in the community. The only way they're going to be able to change that is to go out and acquire, have a grassroots strategy where they stand something up with the other points. So you don't have to comment on that.
Well, I'll only say, I mean, I think competition makes everyone better, and the small and medium-sized IMBs have shown over time that they're incredibly resilient because they do know their communities and have relationships that it cannot just be generated, at the push of a button.
No question. No. Number one on your list of things you're working on, and I need a better understanding. I'll surrender to you there. So just give us a quick glimpse into what finishing Reg X servicing reform rule, looks like and what it means to IMBs.
So very simply, this only matters to your IMBs if you service, because this is the servicing part of the RESPA Reg X rules. So we're not talking about Section 8 anymore. We're talking about servicing rules that the Bureau put in place in 2013. They came out with a proposal in response to an MBA petition that they do a rulemaking around how to streamline and improve those mortgage servicing rules. And I'll just say very simply, our hope is that they take the good parts of their proposal. There were some parts that we didn't like as much as others, but that they take the good parts of their proposal and finalize it so that we're able to offer people loss mitigation solutions in a really streamlined way, that we don't have to collect docs we don't need. We don't have to confuse them with multiple notices. If they're eligible for, say, a forbearance, they just get the forbearance and are able to move on without kind of a more confusing complete application framework that is currently the case in the CFPB's rules.
Thank you for that.
Sure.
So we're coming up on time here. I've got this shirt on here. You have any idea what this means? All of us?
Well, you also have it behind you. So yeah, I think my guess is that you're advocating on behalf of the entire mortgage industry. And I think at MBA, we do that every day. So I really appreciate both the shirt and the neon sign, which is very cool. And
I might send you a neon sign to put right in between all those doors. Are there more doors in the room, by the way? Are you at 3 or are there more doors in that room?
So there's 4. The closet has 2 doors. So it's 4 total doors. So it's a lot. It's a lot. And I've got a window which opens to the outside.
You probably have an extensive wardrobe.
You are giving me far too much credit. And I would love to add an All of Us sweatshirt if you can find it in your heart to send me one.
If you'll wear it, I'll send. If you'll wear it,
absolutely, I'll wear it. Heck yeah, I'll wear it.
And I'll just make the comment that I am wanting to work closer with the MBA. I see the value. I know the work that you guys put in. Doesn't mean we all have to agree all the time, but to the extent that we can bring more leaders from the mortgage industry together at the table to have communication and conversation so we can forge a better future together, I'm all about it. So I really appreciate your willingness to come on and all that you and the organization does for us. I'm a proud member of the MBA and will continue to be.
Thanks. I appreciate it. And the thing I would say is your passion for the industry, your passion to find solutions that benefit everyone is exactly what we try to do. So we're glad to have you in the MBA 10 and hope you continue to be engaged.
All right, Justin Wiseman, my neighbor and also the vice president and managing regulatory counsel at the Mortgage Bankers Association. This has been a great, quick moving 33 minutes and 35 seconds. We'll catch up again here in the near future. Hang on the line here so your video can download. Everybody else, Taylor Stork will be with us next Monday. We'll chop it up, the president of the CHLA. Till then, have a great first week of March. This has been a lot of fun. Justin, take care. We'll talk soon.
Thank you.